Hello everyone, I'm Mitul Patel from IIFL Asset Management and I manage the IIFL Multicap PMS and the IIFL Multicap Advantage PMS. Firstly, I hope that all of you are safe and healthy at home, and I would also like to thank PMS Bazaar for giving us this opportunity. PMS Bazaar has been doing an excellent job in educating investors regarding the PMS space, and I would like to wish the team all the best for the future. Every one of us is going through an unprecedented event, and this has created heightened volatility in global markets, and there have been steep drawdowns in the month of March across global equity indices. As the agenda of this video is to give everyone perspective as to what is happening, I thought I will start by quantifying as to what we have been experiencing over the last month or so. The Indian equity markets hit an all-time high around the mid of January, and towards the end of March, we saw that the market was down 38% from its all-time high. In the month of March, in its entirety, the market fell 23%, and the daily intraday moves in the market were extremely volatile. There were 22 trading days in the month of March, and roughly 16 days out of those 22, the index saw swings of roughly 2%. And to put that in perspective, during the entire year leading up to February 2020, there were only 6 such days. And to top that off, the index had the largest intraday swing ever in its history of 18.3%. We have experienced these drawdowns in the past as well. In the last 34 years, for the data we have looked at, the BSE Sensex has fallen more than 20% at least 11 times. That is once every 3 years. And since we are down roughly 25% from our peak recently because of the coronavirus, the greater than 30% drawdowns in the Indian markets have happened roughly 7 times. That is once every 5 years. These drawdowns of 20% and 30% include all the crises that the country has faced before, such as the 1991 economic crisis, the dot-com bust, and the 2008 great financial crisis. While these statistics are sobering, what has happened after the crash is what makes me optimistic, and the fact that this also shall pass. It takes on average roughly 2 years to recover from all-time highs from the bottom. As obviously it's impossible to say where the bottom is right now, but a recovery to all-time highs in 2 years would translate of an annualized return of roughly 19%. Even if you take the worst historical case, that would yield roughly 12.5% annualized returns over 3 years. Also, I would like to point out that the BSE 200, which is our benchmark, is roughly trading at 2 times price to book. Again, to put it in perspective, this benchmark has traded only 5% in its entire life at below 2 times price to book since its inception. Clearly, this is not a time to be fearful. Coming back to the present, our country is under lockdown, and India has seen one of the longest and the most strictest lockdowns globally. This will definitely have some level of economic impact in the short to medium term. It all depends upon how fast or how quickly the lockdown is lifted, and also how fast businesses come back to normal. Equity markets globally as well as in India have rebounded from their lows, and just as an example, in the US, this rebound from the lows, this pullback, has been one of the fastest pullbacks from a bear market in the last 50 years. One of the main reasons for this pullback is because of the fact that governments and central banks across the world have responded by unprecedented actions by pumping in large sums of money into the economy in the form of fiscal and monetary stimulus. Central banks across the world have lowered interest rates to historical low levels, and the fiscal stimulus, for example, in the US is currently at $4 trillion, and that is roughly 11 to 12% of GDP. Globally, this fiscal stimulus ranges from 2% of GDP to 20% of GDP. Coming to the portfolios and our funds, our proprietary SCDV framework has helped us to deliver superior performance over the last few years. Our IIFL Multicap PMS was ranked amongst the top 3 funds in calendar 2019, and our IIFL Multicap Advantage PMS, which has an hedged option, was ranked number 1 in the month of March. Currently, our portfolio is 70% into the secular and defensive bucket, and the balance is under cyclical and value traps. 53% of our portfolio is in the large cap category, and since we are a multi cap PMS, the balance is under mid cap and small cap. Also, I would like to highlight that during these uncertain times, leverage can, cause a lot of problems for businesses, and due to uncertainty of cash flows, we have consciously tried to avoid leveraged entities in our portfolio. Apart from the financial names that we own, our portfolio comprises of companies that are net cash companies or companies which have minimal leverage. Most of the businesses that we own have durable business moats, high quality of management team, and prudent capital allocation. Lastly, I would like to say that although the future could be is uncertain right now, the best way forward is to own a portfolio of quality businesses, and that can have the ability to withstand problems, such as the ones that we are facing right now. Lastly, I would like to say that at IIFL AMC, we are constantly endeavoring to invest your money prudently and to deliver superior risk-adjusted returns over a long period of time. Thank you very much.